How do real estate and capital gains tie together? Hi, I'm Paul Mihalowicz with Birmingham Realty Team in Southeast Michigan, and I want to talk to you a little bit about capital gains and real estate and how the two of those tie together. And when we talk about this, there's really going to be two scenarios where we're going to get into capital gains. Scenario number one is going to be on your primary residence. So for example, if you own a home and you sell the home, and if you're single, you can keep up to $250,000 tax-free, or if you're married, you can keep up to $500,000 tax-free. In the event you've got more than $250,000 or $500,000 in gain, you are now going to have additional income. Well, here's the good thing. As long as you've owned that home for more than 1 year, that is going to be considered long-term capital gains. And so you're going to pay your capital gains rate depending on your income, which could be up to 20%. Another scenario where you're going to run into capital gains is going to be on an investment property. So any investment property now, if you're flipping, if you do it in less than a year, I want to make sure we're clear here because I actually misunderstood this myself. This was a mistake I had early in my career. I was like, it's an investment property. It's capital gains, no big deal. So I don't have to treat it like normal, ordinary income. I was totally wrong. If you own a home for less than 1 year and you sell it, that's going to be ordinary income. You're going to pay your ordinary income rate. So the same rate you're paying on your income from your job, you're going to pay that same rate on that capital gain if you held that property for less than a year. Now, if you've owned that property for more than a year and you're going to sell that property, that's going to be considered capital gains at that point. And now any rental property, hopefully you've owned everything over a year. So when you sell that, you're going to have capital gains. So on your primary residence, if you exceed your tax-free exemption on your investment, it's pretty much going to be all of it. So now you've got this capital gain. Well, what do you do with it? Now you could just pay the tax, just pay the man and pay. Let's just assume it's 20% again. Remember, talk to your CPA. They'll tell you the exact rate, but let's run with 20% for this example. You could just pay the 20%, put the cash in the bank, you're done, and you can move on with your life. There are no rules or restrictions on what you can do with that money. Just pay the 20%. But the thing that's become extremely common for most investors is to do something called a 1031 exchange, or the longer form is a 1031 tax-deferred exchange. So let's assume you bought something for $1 million, sold it, you ended up having $500,000 worth of gain on your investment property. So you could go ahead and pay the government, $100,000 and keep $400,000 of it. You can take the whole $500,000 in gain and put that into an account. Then you can find a replacement property of equal or greater value. And now it could be one, or maybe you could put 2 or 3 together properties. As long as the total value is greater than that property that you sold, you can now take that $500,000 gain, roll it into a new property, and defer paying any capital gains taxes on it. It's really cool. It's basically a $500,000 in gain. Just rolling into another property, you don't pay any taxes. Now again, you want to make sure we're clear here. It's a tax-deferred exchange. It's not a tax get-rid-of exchange. You're just deferring it. So at a later date, you do sell that property, you will have to pay the capital gains on it at that point. But there's a strategy that becomes pretty popular called swap till you drop. And that strategy is just to keep you exchanging and exchanging until the day you pass away. And then the beautiful part is, let's assume the property is worth $2 million at the time that you pass. Your kids will inherit that property at $2 million and they could sell it and they don't have to pay any tax on it. Pretty cool, isn't it? So lots of cool stuff. I don't know if loopholes is the right word for it. That's probably not the best word, but it's what it is. It's a loophole, and that's okay. Any chance we get to find a loophole to work within the rules given by our great government, we're going to take it. So if you're selling a property, you're going to have capital gains. You should definitely look at that 1031 exchange. And then again, you just keep doing those until the day that you pass. Then the basis steps up to the value at the time of your death, and your kids sell it and not pay any of those taxes. So that's the strategy to really win with investment property, or even with your primary residence if you had some gain left over after your exemptions. So if you want to learn more about investment properties and capital gains, and you're thinking about selling, you want to roll it into something bigger, our team at Birmingham Realty would love the opportunity to make that happen for you. And just remember, always want to check with your CPA to verify what tax bracket and how to do some of this stuff. Give us a call, shoot us a text at the number below, and that'll connect with our team. I would love to learn more about what your goals are. Put a plan in place to help you accomplish them. I'm Paul Mihalowicz with the Birmingham Realty team. Thanks for watching, and stay tuned on new topics on selling in Southeast Michigan. Have a good one.